this business recovery series session with Enterprise Uganda. My name is Joshua Mazune, and I'm the Managing Director at MARU Credit. Today's session is about understanding credit from the lender's side, not so you can please lenders, but so you can build businesses that are disciplined, resilient, and financeable when both need and opportunity arise. Everything I will share today is based on real SME assessments we conduct daily. So why does this conversation matter? Many Ugandan SMEs fail not because they lack opportunity, but because they are financially unprepared. We are operating in a market where access to finance is tighter and lender scrutiny is higher. Capital is available, but only to businesses that demonstrate discipline. Creditworthiness today is not optional. It determines whether your business survives shocks, recovers faster, and grows sustainably. Creditworthiness is often misunderstood. It's not revenue size. It's not years of operation. It is not passion or ambition. Creditworthiness is the specific ability to borrow and repay predictably over time. From a lender's perspective, from our perspective, consistent cash flows matter more than profits. Discipline over time builds a track record, and track records build trust. Basically, can we trust you with the money that you are advanced? Lenders do not lend against promises. We lend against behavior. We focus on cash flow reliability and total repayment capacity. We assess historical patterns, not future hopes. Systems and records matter more than size. Consistent reporting signals lower risk. If your systems are weak, lenders assume money will leak even if sales are strong. So what do we notice in the first 10 minutes? Lenders look for credibility signals. We check bank account behavior, regular deposits, controlled withdrawals, and stable balances. We look for patterns. We look for cash flow evidence that matches claimed sales. We check whether business and personal finances are separated. We review existing debt obligations and repayment history. We ask whether the loan purpose is clear, measurable, and linked to cash flow improvement. Finally, we look for consistency across records and basic identity verification. These are not advanced checks. They are trust checks. Professional lenders expect basic financial infrastructure. This includes daily record keeping, reconciled bank accounts, active cash tracking, and organized statutory documents. These systems are not corporate luxuries. They are signals that the business is controlled, predictable, and accountable. Most SME liquidity problems are self-inflicted. We cause our own problems. Mixing personal and business money destroys visibility. Some SMEs might be operating from the same account for their personal needs and their business needs. Misusing loan funds breaks trust. Uncontrolled credit sales delay cash. Overdependence on one customer concentrates risk. What happens if that one customer you supply faces an issue? That issue can extend to you. So these issues are not about intelligence. They are about discipline. Cash discipline starts with behavior. Separate business and personal finances completely. Pay yourself the fixed amount. Pay yourself a small salary, depending on what your business can afford. Track cash weekly, not only when there is a crisis, even daily. Prioritize loan and tax obligations before discretionary spending. Basically, be compliant. So these habits protect your capital more than new funding ever will. You do not need expensive software to start. A lot of people may think systems are about expensive software. Not really. Open a dedicated business account so you can separate your money or your personal money from your business's money. Prepare daily or monthly cash summaries. Track invoices and receipts consistently. Implement simple expense approval controls. Consistency matters more than sophistication. So this slide shows the difference systems make. Businesses with systems have weekly cash visibility. Those without systems operate on guesswork. Businesses with systems follow up receivables. Those without systems wait and hope. Expense controls exist in structured businesses. In chaotic ones, money leaks unnoticed. You don't know where the money is and you don't know where it's going. So from a lender's perspective, systems reduce uncertainty, and uncertainty is what lenders price. So when you walk into a lender's premise, whether a bank, a tier 4 institution, the interest rate goes up based on the visibility they have on your business or how risky they may consider you. So growth is not the same as scale. Increased sales without systems increase risk. To scale requires documented processes, controls, and discipline. I keep emphasizing discipline. Debt magnifies behavior, whether good or bad. So if you can mismanage a small amount of money, you might mismanage a big one. This is why lenders fear fast, uncontrolled growth more than slow, disciplined growth. Before approaching a lender or an institution, ask yourself the following questions. Can you predict cash flows for the next 6 to 12 months? Are business and personal finances strictly separated? Do you understand the impact of repayments on your operations? Can your records withstand professional scrutiny? If the answer is no, the issue is readiness, not rejection. So discipline is easier with support. This may include structured programs, mentors, financial advisors, and improved bookkeeping, whether through the MARU incubator that was mentioned earlier, that will take place at the end of this month, or other credible partners. The objective is the same. Systems before scale, discipline before debt. So I'd like to encourage you to go on a 30-day creditworthiness challenge. Week 1, you focus on separating finances and running a weekly cash review. So in that week, if you are in the habit of operating from one account, separate them. Pay yourself a salary or a stipend. Week 2, focus on receivables and data follow-up. Week 3 focuses on inventory discipline and expense control. And then week 4, you focus on preparing records and a lender-ready folder. This is how creditworthiness is built step by step. So a lot of the time in our business, SMEs approach us last minute. But these are problems they might have anticipated maybe weeks or months prior. And it's best to even go around and shop and see who has the best interest rates or the best terms so that you're not taken advantage of. So this challenge might help you become better at improving your credit worthiness. So credit worthiness is built daily, not when you need the money. Cash discipline protects your business. Systems reduce risk. Smart growth attracts better financing. Borrowing should strengthen your business, not rescue it. So thank you very much. I welcome you to ask some questions or some clarity that you may need from what I have shared.
Wow, this has been so direct to the point. And so sorry for those that have just joined in. Just a minute. Thank you so much, Mr. Mazune. Ladies and gentlemen, please let's go to the chat and just clap or give a round of applause here for Mr. Mazune for taking time to, break these things down in a very simple way, very simple way, helping us, see how we can build our businesses to be credit worthy. He has emphasized issues of discipline, building systems before skill, discipline before we go for debt. Yeah, and just trying to reflect on my personal business also, and to see whether so that the consistency then matters. So it's not a one-off where you be serious one time, then you're not. Separate your personal finances from your business finances, and so credit institutions track behavior. They realize they see patterns of how you're conducting business, things to do with record keeping. Amazing. Yes, the floor is open for Q&A. Feel free to shoot up your hand. I see there is Wabulembo Faziri here. Please do unmute and ask your question. Faziri?
Yes, thanks a lot. Thanks a lot. Good morning, everyone. And thanks a lot for this insightful presentation. Indeed, we need to build our credit worth. Now, my question is about separating personal financing from the business. We do happen that most of the entrepreneurs are operating or they're operating small businesses whereby they get money from the business to support their personal day-to-day living. So in that case, for example, you can make some sales, but then you can't say that the cash that like you are going to deposit the money in the bank because you don't have lunch. You have to pick money for lunch from that same sales that you have made. Also, you can't say that you are keeping the money in the bank when the child is sick at home. So how best can you tackle such a particular enterprise whereby you are surviving, your personal survival is basically looking at the business income. So you are getting the business income for your personal survival. How best can you now separate that? Thanks a lot.
Thank you, Faziri. That question has been taken. I'm going to invite Margaret. Mr. Mazune, just kindly note down those questions. Yes, Margaret, please unmute.
Yes, thank you so much. I'm really grateful that I managed to be part of this session. So I have two questions. One is just really to appreciate the point that the presenter has made of borrowing to strengthen the business and not to rescue it. And I think I've come across many businesses that have had that trap. And it's a serious one. Maybe it needs to be really, people could give case studies and if you have any, Mr. If you have any, sir, I don't know where I wrote your name, please share with us. The other one is separating business accounts from personal finances. That's very true. I've just had a few challenges because sometimes you want to pay URA and the banks tell you can't pay direct. And yet for me, the bank is the best way to track to track my expenses, because every time I do a transaction, I record within my system, I've sent this money to so and so for this and this reason. So with URA, it has disturbed me. So I first withdraw the bank, send the money to my personal account, then remove it in order for me to take it to URA, and it can distort the report. Someone can think I'm getting that money for my personal account when actually it's not the case. Yeah, thank you so much.
Thank you so much, Margaret. Let's take one last question, and this time I'll go to the chat, and then we shall allow Joshua to respond to those questions. Okay. I see. Spot on and relevant. I like the point to borrow to strengthen, not to rescue the business. Okay. Paya says, my question, how does one ensure that their business is managing cash, especially if you're not near any bank in a rural area? Okay. Bob says, very well presented, directly hitting on core points. Is there a possibility of sharing the slides? Okay. So this presentation is usually uploaded to the YouTube channel of Enterprise Uganda. Please go like it so that you get notifications every time we upload. Let me invite you, Joshua, to come and address the questions that have been shared.
Thank you very much, Anita. I would like to answer the first question. Sorry, I didn't get your name, but your question was about taking money out of the business for survival, maybe taking money out to buy lunch, to maybe if you have an unfortunate situation of a sick child. So these are understandable, but one way of, you should do this in a proper way. For example, if it is predictable expenditure, like lunch and maybe transport, you could get a simple matrix. For example, if you say lunch is 5,000 shillings per day or transport is 5,000 shillings per day. If the business can afford it, maybe you pay it weekly. If the business may not afford it and you say we shall pay this daily, but you document it, as opposed to the practice of pulling that 10,000 shillings out of the till. Let's say you run a grocery store, a supermarket, a mini mart. If you're to grow past that survival mode, you might take on or continue that practice where even staff, because they've seen the boss pull out 5,000 shillings or 10,000 shillings, they might end up doing the same. But if they find a system that requires you to maybe prepare a requisition, and maybe you've pulled out the 10,000 from the safe that's maybe in the back office, it will help plug those leaks that could happen in the future. And if possible, please document this. So at the end of the month, if you say your salary is 300,000 or 500,000 or whatever your business might afford, this is taken out. You say, okay, fine, my business can afford to pay me 500,000 and a lunch allowance of 100,000 per month. So when you're paying yourself at the end of the month, you treat that 10,000 shillings or 5,000 shillings that you are taking out of the till every day as an advance that you are getting for lunch. A lot of times people may tend to forget this. And these are the small sacrifices that we need to make as business owners. In the unfortunate event of a sick child, the same principle might apply. If the business has advanced you money for that purpose, is it possible for you to pay it back? You've documented and said, okay, I spent 500,000 on treatment or on school fees, and you documented taking out that money as a drawing. Can you pay it back? So a lot of times, business owners treat their businesses as a piggy bank of sorts where you can just pull out money, or a current account. We need to be richer than our businesses so that you can always rely on it in times of need. So the focus should be on growing it, not you draining it. You should treat it like you are fattening a cow or you're feeding it well so that you can milk it. If you don't put in the input, the good fertilizer for the grass, or the inputs, the acaricides, or whatever that you need to put in, you won't be able to get enough milk from it. So we need to feed our businesses, not necessarily keep taking out of it. So don't be richer than your business is the principle that I would like to convey. And on the second question from Margaret, she made a comment about the loan that you take from your business should strengthen your business and not kill it. That is true. Now, a lot of times, businesses may borrow for the wrong purpose, and that's when it can kill your business. For example, you might borrow a short-term loan for a long-term need. Let's say you are completing a house and you take on a loan for 3 months, yet you are going to, let's say, build the house or finish it over 6 months. And the monthly installment that you may have to pay, you don't have a grace period, you have to pay after 30 days. That money is not the right money for it. Or if your business, you are going to, let's say, start a farm or expand on your current farm, and you borrow money that requires you to, say, pay a portion of principal and interest within 30 days. There's no holiday. That may not be the right money for you. Or you're borrowing money at an interest rate that is over and above the profit you may get from the job that you're borrowing for. If, say, you have a small deal of 1 million shillings, 500,000, and your profit on it is, say, 100,000. But the money you borrow requires you to pay back 120,000 in interest. Clearly, at the beginning of that transaction, you're in a loss position. So you need to understand this before you borrow. That is why it is important for you to weigh your options way before you need the money, because that time will always come. For example, children are going back to school now. And if you've looked around social media, a lot of different institutions, the banks and telecoms, are advertising school fees loan product. But if you need school fees, will you go to the first person that you meet and then transact with them? Or would it be better for you to maybe have anticipated this a month ago, and then you look around and weigh your options and terms across all the different options that are available for you? You go to Bank Y, Microfinance, Z, look at their terms, get the documentation well ready in advance, because that problem, you might have foreseen it. So it's best to go and prepare yourself way before, because when you go a day to children going back to school, and that is when you need the school fees loan, this is provided there was no unforeseen issue, for example, salary delays, something like that. But if things have been consistent, you knew that you're going to get paid, let's say, a month later, or you would not have the money in time, it would have been best for you to do this research way earlier so that you can identify the right financier for that specific need. Because when you go last minute, you may end up getting taken advantage of, or you get a raw deal. I don't know if that answers your question, Margaret.
Hey, Margaret, you could probably give us a thumbs up. All right. She acknowledges. Thank you. Oh, great. Let's have Bob. Bob, please, if you can. There was one more question. I don't know if you were able to capture that, the third one, but let's allow Bob.
Sorry, what was the third question? And Bob's as well?
Yeah. Let's allow Bob to unmute. Bob, please, if you can unmute as I locate the third question.
Hello. Thank you. Thank you very much. My question is, okay, supposing you have systems and you're following all those other procedures the moderator has presented, but when you go to do audit, sometimes the auditors feel that these low-cost simple systems take their time to check for the information they want. So they advise that you put those sophisticated systems, which are a bit expensive. So how best can you deal with that situation, basically? And then two, if you initially started the business and you've been recording, how much more money can you lend your own business? And when is the best time to start paying back? And is it advisable that if you've lent your own business, you put an interest, which is not so much, but at least some small interest to keep the best practice going? Thank you very much.
And thank you so much, Bob. The other question was, how does one ensure that their business is managing cash, especially when you're not near any bank when you're in a rural area? Okay, there's someone requesting for your contacts in the chat. You let us know how that can be available. Then Janet here asks, how do you handle the credit when you're in a seasonal business, for instance, suppliers like stationery and graphics designing, because the income may not come daily. So I think she's asking, how do you build that, of consistent income? Okay, I think please come, Joshua, and answer those as we get other questions. Yes.
Thank you, Anita. I'd like to start off with the question from Bob, who was asking about system costs and if auditors come in and request you for maybe more expensive systems. The system you get for your business should be one that your business can genuinely afford, to be honest. There are systems that are free, all the way to systems that cost millions of dollars. So it wouldn't be realistic for your business to go and look for an expensive system because an auditor or this other person has recommended it. Systems, first of all, even before you get to systems, for example, if you're implementing a system, right now at MARU Credit, we're in the process of implementing a different system. And we had to provide our system developer with an end-to-end process flow, from how we open to what we do when we are appraising a loan to who does what. You could start with that. A system doesn't necessarily have to be the technology. A system could be the process flow of your business. Bob, I'm not sure what business you're in. If maybe you could quickly unmute and mention so that maybe I could address it directly. So assuming Bob operates...
Hello. It is construction.
Yes?
Construction.
It's construction, yes. So you may not necessarily need an ERP system to run your business if you can't afford it. You may start with the core things. For example, if construction, your biggest process is in either procurement or labor management or quality control, you could start by getting free tools. Odoo, for example, has I think you can get one free module, and that's the one maybe you could start with before you roll out to the rest. But starting with documenting your processes so that everything is standardized. For example, when shifts change, someone just comes in, they look at the document, they've signed off, they're saying, okay, fine. When you're leaving site, this is what you need to do. This is where you need to start. Who opens? How do they open? How is inventory kept? The technology helps your system or your processes become easier. So you could start with a manual system, which is basically a lot of paperwork, and that's the cheapest thing you could do. Now, you asked about lending to your business. That would be the best thing to do. before you seek external financing. The best financing is first from your savings. Then 2, if you could possibly lend your business. 3, maybe friends and family before you seek external debt. But the best thing would be to document it. Look at your businesses. You need to separate yourself in that moment. You have Bob, the lender to his business, and you have Bob, the MD of the construction company. Bob, the construction company, what can your business genuinely afford to pay in interest and in installments? For example, if it's a construction project and you need X amount of money to maybe complete the project and you're going to get paid after 3 months, Bob, the lender, should not lend Bob, the construction CEO, and tell him after 30 days, start making installments, when you know that that money will not be ready at that point. So it would be best because you can set the terms that your business can afford. That would be the best way to do it. And then you put in a small interest that can make sense. Then there was a question about how to ensure your business is managing cash, especially in rural areas where banking services may not be readily available. The good thing is we are in the mobile money era. I think there are more mobile money accounts than there are bank accounts in the country today. That is one option. Mobile money agents are available every 100, 200, 300 meters or so, especially if you're located in a town. That also takes away the risk of theft. You've had stories of people's shops, especially people that deal with a lot of cash payments being raided. It takes away that, what should I call it, that motive from staff and also from external forces thinking about robbing your store. So embracing digital tools like mobile money, agent banking, merchant codes would be one way for you to deal with the cash situation. And then the good thing about these tools, mobile money, for example, Momo Pay and Airtel Pay, have portals online where you could balance the books and see exactly how much you have, and then you liquidate it onto a bank account later. Cashless would be the right way to go. There was a question from Janet in terms of managing cash, especially seasonal businesses like supplies. The first thing you would do is, I didn't talk about this earlier in the presentation, but every business needs to save, especially such a business. Because if you're getting paid 3-4 times a year and you're getting lump sums, and you're going to go through, let's say, 3-4 month, 6-month period without cash, you need to rely on these cash reserves. The same way you as an individual, Janet, Bob, Margaret, and everyone else on this call might be saving. You have your Chivina that you're part of, you have a circle, you are saving money. Your business needs to save. Whenever you receive a payment, don't take out all the money. Otherwise, in a situation like this where you need financing for a job, that money won't be available. And then now you have to resort to borrowing. Borrowing should be supplementary. Set a benchmark for your business. Percentages would be best, depending on what your business can afford to save or what your margins are. If you make 1 million shillings as revenue, and let's say 200,000 is profit, can you put aside 50,000 of that in a savings account for the business? There are these options that are available now. Unit trusts are the best. Even for the cash that is idle in your bank account that hasn't been deployed, can it be put in a vehicle that's at least generating a little bit of a return, so that at the end of the period, you have some savings, and those savings have at least attracted a little interest that you can then now deploy to a job. And if that is not enough, that is when now you seek financing in terms of loans. Even lenders, from a lender's perspective, that is the kind of borrower that would be best. Someone who has some skin in the game. It demonstrates to financiers that this person is serious about the financial health of their business. So, Janet, please, from whatever job make, you supply, and you've been paid, because you know you're going to take a while to get paid, put aside that money in a vehicle like a unit trust that has some interest, and you're earning that, you've saved it for the next job. Then when the next job comes and you have at least 70% of the money, that is when now you seek some extra money to borrow. And then that cash buffer that you have on the side will then help you manage your day-to-day operational costs. But if you take it all at once, whenever you get a job, it may not work well for the financial health of your business. Thank you.
Thank you so much, Joshua. Before I invite Robert, okay, Margaret, his hand is up again. Before I invite Robert, I just want us to take note of some of these questions. Solomon asks, are there any general frameworks of systems for basic enterprises, a document, table, grid that highlights the necessary systems at most basic enterprise level? I know you've hinted on it, but you could elaborate more. Emmanuel says, thank you, Joshua, for the brief and simplified presentation. While it covers largely existing or ongoing businesses, could you please comment on startup businesses which are yet to get off the ground, yet need funding? Also, if possible, mention such possible startup funders. Okay, Process says, thank you. Okay, so Robert Sevunya, please unmute and ask your question.
Thank you very much, and thank you very much, Joshua, too, for the succinct presentation. I'll be a bit more direct. How different does MARU treat a high-performing, scalable, credit-worthy SME differently from the top banks that seem to strategically understand SMEs? For SMEs, typically, I'm a former banker who has recently moved into techpreneurship. So I see the differences between the rates I was going when I was a banker versus, but also in the marketplace, there's not so much credit for SMEs. So repayment holidays, the appetite for the type of business you're looking up for, you know, how is MARU different from the banks that seem to, the particular banks that seem to understand the SME? For context, I'm running a holding company with interest in marketing and technology, providing for SMEs, further providing for microfinances and banks technology for the two. Thank you.
Thank you, Robert. Margaret, please unmute.
Okay, thanks again, Joshua. This time I'm following up a suggestion that you've made, and I would really like to take it up. Saving for the business. Does that require opening another account, you know, in another bank for the business? How does that happen? That's it. Thank you.
Thank you, Margaret. Joshua, please, if you could come in.
All right, thank you. I'll start with Margaret's follow-up question regarding saving for the business. Yes, it would be best for you to open a separate savings account for your business and a unit trust account, for example, for your business, so that you have two. So you have the savings account and the unit trust account. The unit trust account with the different providers. From then, when you're liquidating, or let's say you save on this bank account, that money is then transferred to the unit trust savings account. And then if you're transferring it back from the unit trust, it liquidates to that particular account. And then that savings account that you use can be sort of the first lender of the business's operations. And that should be like first priority. You pay it back, you don't forget. That's the reason why you should have a separate account for it, for traceability, even before you put it for easy traceability. If you've saved 5 million, 10 million in that account, and it's in a unit trust earning some little interest, up to even 13%, 14% per annum in the unit trusts available, that is decent money. That's 1.4 million, for example, that it has generated. Now, when the business has a job, a supply of 5 million shillings, and they don't have the financing, they can borrow from the savings account. So you withdraw from the unit trust account, it liquidates to the savings bank account. It could be in the same bank, just a different account number. And then you borrow the 5 million to the operations account for that business. When you get paid, you transfer that money back because you borrowed it from the savings account, plus the percentage you set for your business, whether it's 10%, 15%, and you're dedicated to it. So you've transferred back the 5 million you borrowed, plus the percentage of the profit that you made back to that account and then to the unit trust. Regarding Robert's question, how different does MARU treat customers? And you mentioned you run a holding company that's into marketing and technology. What we pride ourselves with is turnaround time and customer support. So we lend primarily to SMEs, and SMEs that some get financing from the bank and others that may not have qualified for banking services, which is something we're trying to address with the MARU incubator that we've partnered with Enterprise Uganda on. So whilst a lot of banks may not take, say, a logbook as collateral, we do. While banks may not typically provide financing to an SME within 24 hours and they're telling you 2 weeks or 3 weeks, we do. It goes back to the history of the business. I'm an entrepreneur myself and I'm involved in a few other businesses. And the birth of MARU started from a business that I'm part of that needed financing. And it took us about 3 weeks to get financing from one of the commercial banks around. And it was such a strenuous process. I know a lot of you have gone through this challenge before. So that unlocked it opened our eyes to the need in the market for quick, accessible financing to SMEs like us. Granted, we should have been more organized and prepared our documents well in advance because we anticipated the job. But the process that we went through, waiting 3-4 weeks to get financing, really affected our performance on that project. So we come in to offer bridge financing against a logbook of the vehicle. We're trying to look into other products where we could provide financing against machinery, for example, for those in agriculture. But those products we shall roll out later this year. And that challenge is because of the things that I mentioned earlier in my presentation. We need the financing, but we don't know if they're creditworthy or not. So we're trying to build models that can help us test and see and give us some visibility into how credible they could be if we provide financing to them against machinery they might want to procure for their business. So our turnaround time. So we have loan products that we disburse even same day. Someone walks in the morning with the 3 requirements that we need: a logbook of the vehicle, a bank statement for 6 months, and a national ID. We run their financials, and by evening, they've received their finances. So that is our unique selling point. We sell speed and convenience for a customer. Someone asked about startups that need funding. The best funding a startup should use is their savings. And that's the unfortunate truth. And before we even get into grants that are available, which are sometimes very hard to come across, businesses need to start with their own savings. So that in the unfortunate event something happens, all you are losing is your savings. You're now not indebted to a third party or who maybe you staked property with. Maybe you put your chibanja with a bank, with a microfinance, and then you struggle paying back. Then also, if beyond savings, the next thing would be friends and family. If that option isn't available, partnerships. but also getting the right partner, which is a whole other conversation. So when you get into partnerships, it helps reduce the capital that one person might contribute. So if we needed to start this business with 10 million shillings, if you're alone, that is a huge burden for maybe, let's say, one person. If you're two or three, that risk is spread across three people. So before someone looks for debt, their savings, their personal savings, friends and family, they should be open to partnerships. They sell their idea to other like-minded people who might buy into the vision of the business. That is before they go into debt. Now, when it comes to debt, they need to understand the kind of debt that they're getting. Because a lot of people might borrow, they want to start, let's say, a farm, and they are borrowing money from which they have to start paying monthly installments. That is the wrong financing for that business, and they shouldn't touch it. Because on 30 days later, you'll start paying back that institution with the very money that you borrowed. So that's already a bad deal, and it won't go right. So people shouldn't gamble and try that. There was a mention and ask about the systems to use that are available. There are very many systems that are available, but it depends on the need of the business. Those that I could recommend for micro and small businesses will be things like Odoo and Zoho. I don't know if you've seen some of the billboards in town that are advertising them. Odoo and Zoho are relatively good and affordable systems that a business could start using. Thank you very much.
Thank you. Thank you so much, Joshua. Thank you for sharing genuinely and, professionally. And this is good information for us as entrepreneurs. And so I want to thank you. And for the entrepreneurs who would have probably many questions and would like to engage more with Joshua, we have a training coming up. Last week of Feb, the tentative dates are 25th to 27th of February. We shall put out a link where you'll be able to register. Please do register because MARU Credit has a MARU Incubator. It's a program that helps entrepreneurs to forge financial discipline and sustainability. And so we shall be sharing more on the different Enterprise Uganda groups about what the training will be about. And so you will interact directly with him when you come for the 3-day training. Please endeavor to register. This will be good for you, and this will be good for your business. And so right about now, allow me invite Joshua to come and give his parting shots, and then we see how to bring this conversation to a close. And maybe, Joshua, if you don't mind, kindly talk about the session, the upcoming training a bit in detail. You can sign up. The form has been shared right there. Please feel free to click on it and sign up for the training that is coming up. Thank you. Over to you, Joshua.
Thank you, Anita. So MARU Credit, in partnership with Enterprise Uganda, is offering a 3-day intensive incubator workshop. And we're focusing on helping entrepreneurs strengthen their business systems, improve financial management practices, and understand what makes a business creditworthy. This is a highly practical program that's designed to equip participants with tools and insights. So this workshop will take place from Wednesday 25th to Friday 27th of February this month, running from 9 a.m. to 4 p.m. at Enterprise Uganda in Butabika. The program fee is 350,000 only. However, for this intake, we at MARU Credit have decided to fully sponsor the first 50 SMEs who meet the selection criteria. So that means qualified participants can attend at no cost at all. Slots are limited and expected to fill quickly. So I really encourage you, those who are interested in participating in this, to apply as soon as possible. Thank you very much.
Thank you so much, Joshua. There you go, entrepreneurs. Thank you, MARU Credit. The training costs 350,000 Ugandan shillings, but for the first cohort, the first 50 entrepreneurs will be considered and they will not pay the fee. And so why not take up the opportunity? Thank you so much once again. And now from us at Enterprise Uganda, first of all, we want to say thank you to all the entrepreneurs that showed up last week in large numbers. You are more than 1,000 here in Butarika at the BDS Center of Excellence. And so I want to thank you. The Business Enterprise Startup Tool happened, and quite a number of testimonies are coming through. Please, if you didn't get your certificate, ensure that you get it. Just reach out and see how you can get your certificate. And so today's conversation has really challenged us as entrepreneurs to think differently. Credit is not just about borrowing, it's about trust, structure, and discipline, and that is what the guys that offer credit look for. Can you be trusted? Do you have structure? They realize they monitor or look at your patterns, and they look at the discipline of how you're managing your finances in the business. And so as we conclude this powerful session on building credit-worthy businesses, we've been reminded that access to finance is not just luck, it's preparation meeting discipline. And so this morning, of course, we've learned that cash discipline, strong systems, and smart growth strategies are not optional, they are the foundation of sustainable enterprises. And so on behalf of Enterprise Uganda, we extend our sincere appreciation to Mr. Joshua Mazune for reminding us that financial credibility is built daily in small decisions, the documentation, and of course, he emphasized that discipline behind the scenes. How are we managing our businesses behind the scenes? And so as business leaders, let us not just seek capital, let us not just seek credit, let us become credit ready. And to all the participants, the real work begins after this Zoom call. Let's go back and let's strengthen our financial records. Let's look out for which credible systems we can build. Let's grow intentionally and not impulsively. Why? Because a credit-worthy business...
Anita, one comment?
Yes.
Sorry for cutting you off.
Sure.
There is a question here from Emmanuel Sanyu that I thought I could answer. He asks, could we talk about bankers who charge their borrowers an insurance fee and yet rarely provide the insurance policies to the borrowers? So this insurance is usually is against death and permanent disability. It does not remove your obligation to pay. That covers death and permanent disability. So that in the unfortunate case that you may be permanently disabled or you pass away, insurance comes in to take on that obligation so that your family is not obligated to pay it. I hope that answers Emmanuel. Thank you.
Great. Emmanuel, I see your hand up. I don't know if still, has your question been answered? Or Emmanuel?
Okay, good morning, ladies and gentlemen. Thank you so much, Joshua, for that response. But my point is, yes, much as the policies are covering, the mortgage protection cover mostly the death and disabilities, but nevertheless, many clients don't get these policy documents, yet the bank charge them, and it leaves their families vulnerable, such that in case this borrower actually passes on, the creditors still come and take their property. Yet there was an insurance in the first place that was never revealed or given a policy document to the borrowers. So my question to you is, why don't you offer those policy documents or endorsements to the borrowers? Thank you.
I agree. If anyone on this call ever approaches a lender and on the offer letter there is insurance, they should demand for their policy after taking up the facility. I can't, for us at MARU Credit, we are very transparent with our clients. If we charge insurance for anything, let's say it's against a vehicle for a logbook loan, we provide the client with that insurance policy. So once that is on your offer letter, please demand for it. If you ask your relationship officer for it and they don't present it, follow up with a formal request in writing addressed to the bank and maybe even copied to the legal manager or the legal department of that institution. Thank you very much.
There you go, Emmanuel. Thank you so much, Joshua. Thank you so much, entrepreneurs. Yes, the link has been shared. We will be here with Joshua last week of February. Please do register. We shall share the link on our different Enterprise Uganda groups. And please come and we learn together, come and we grow. Want to wish you all a blessed and fruitful day. May God richly bless you. Let me see. Miriam Akia, are you able to unmute and give us a word of prayer? Miriam Akia.